everyone. Thank you, Graham, and thank you, Luke. I was pleased to hear you say dullness is a virtue, given the subject matter for the next 10 minutes. Before we move on to business tax issues, there are a couple of changes to capital gains tax that I'd like to quickly mention. Firstly, a reminder that the CGT annual exemption is being reduced from £12,300 to £6,000 from the 6th of April. It's being reduced again next year down to £3,000. So for higher rate taxpayers who are thinking of selling a plot of land or giving some shares to their kids, this is going to mean an extra £1,000 or £2,000 to pay in CGT. So in response to that, taxpayers might want to think about when to use their capital losses, maybe saving any brought forward losses to use in later years. They might want to transfer assets to a spouse to use up their annual exemption as well. Or where possible, they might want to crystallise gains before the 6th of April to bank the higher annual exemption. Lastly, on CGT, a reminder that the new rules that deal with the transfer of assets between divorcing spouse and civil partners also come into force on the 6th of April. Currently, where a couple separate, it is only possible for them to transfer assets between each other on a no gain, no loss basis until the end of the tax year in which the separation happens. So as things stand, if a couple separated today, they would only have 3 weeks to transfer assets between themselves without triggering a potential tax liability. However, from the 6th of April, the no gain, no loss transfer window is extended for a period of up to 3 years and even longer if the assets are subject of a formal divorce agreement. So as I said to that lady over there earlier, she needs to put up with her husband snoring for another 3 weeks before she kicks him out. And don't worry, Jason, I'll be billing her for that later. At the same time, new rules will be introduced to eliminate tax charges arising in connection with sales or transfers of the matrimonial home. Broadly speaking, a spouse or civil partner who retains an interest in that property will have the option to claim private residence relief when it's sold, even where that sale takes place much further down the line. This is a welcome development and means that couples should now not be forced to sell up just to avoid potential tax charges. A less welcome development, however, is the basis period reform. I was unlucky enough to sit my professional exams in the mid-90s. Yes, I know I don't look old enough. Just as self-assessment was being introduced, which meant I had to learn the prior year basis of taxation that operated up until then, the new current year basis of taxation, and all the transitional rules to get from one system to the other. Roll forward 30 years and HMRC is at it again with their basis period reform. So from next year, we'll be moving from the current year basis of taxation that we're all now used to onto a tax year basis. And again, there will be transitional rules in place to get us from one system to the other. These transitional rules come into effect in just 3 weeks' time. It is estimated that around 250,000 sole traders and 1/3 of all partnerships in the UK will be affected, and that will include many of you in this room. There are lots of details and examples in the full pack of budget slides that is going to be sent out to each of you later today. But the first point to note is that going forward, businesses that currently draw up accounts to a date other than the 31st of March or the 5th of April will need to prorate their results to the tax year and will therefore have a much shorter window between the end of the accounting period and the date they need to file their tax return and pay their tax. So this slide illustrates the position for an unincorporated business with a 31 December 24 year end. As things stand, the business owner would have more than a year after the end of the accounting period to finalise their figures and pay their tax in January 26. But going forwards, they will have to wait until the 31 December 25 before they can calculate the figures that need to go in that January 26 tax return. That gives them just a month to turn everything around. So to get from the old to the new basis of taxation, again, the new rules will apply from 6th of April. Again, there's too much detail to cover in full now, and all the fine print will be included in the slide pack you're going to get sent. But this slide gives you an overview of how it will work. You'll see that the profits in the transition year comprise 2 parts. There's the standard part of 100,000 on this slide, which is the usual 12-month accounting profits. And then there's an extra transition part that takes you up until the 5th of April tax year end. If businesses have overlap relief available, this can be deducted from the transitional profits. You can see on here there's some overlap relief there of 20,000. Overlap relief is being removed after the transition year, and so you either need to use it or lose it. If you're not sure whether you have any overlap relief, you need to check that with your advisor or ask HMRC. And after deducting overlap relief, any remaining transitional profits are then spread over 5 years. For loss-making businesses, different rules apply to relieve the losses, depending on how they arise and when they arise. A final point on transitional profits is that although they form part of an individual's taxable income, they are ignored for the purposes of restricting personal allowances and high-income child benefit charges that Graham was just talking about. As well as the complexities of calculating profits from different accounting periods and then spreading them across a number of tax years, the other main issue that arises as a result of the basis period reform is that a taxpayer might not even know what their taxable profits are by the time they have to submit their tax return. Taking the case of a February year end, the second accounting period from which profits need to be apportioned doesn't even end until a month after the tax return has to be filed. This is going to mean that lots of businesses will need to estimate their profits, and this is going to be a particular challenge for seasonal businesses. Large partnerships, even those with an accounting date earlier in the year, may find the shorter timeframes a particular challenge, especially if a statutory audit is required. HMRC has acknowledged that it will be difficult for some businesses to make accurate estimates and finalise their figures quickly. And so the conditions for taxpayers to provide final figures without delay is being relaxed. And this will allow businesses and their agents to amend provisional figures for 1 year at the same time as they are filing the business's estimated figures for the following year. Again, large partnerships are going to be particularly affected as amended returns will be required for every partner as well as for the partnership itself. And interest charges could also arise if the estimated figures are significantly lower than the final figures. So should you change your accounting date? Many businesses already have. They've already changed their accounting date to the 31st of March to simplify the assessment of profits and avoid the need to use provisional figures. And if you haven't already done so, there's still time to think about some of the issues on that slide and to talk to your advisor about it before the end of the tax year to decide whether it's a good idea for you. But should you go a step further, if you've already thought about changing your accounting date and decided it's not commercially viable, should you think about incorporating? All the changes that we have mentioned so far, basis period reform, pension changes, the 45% rate of income tax kicking in at a lower level, plus the corporate tax and capital allowance changes that Jason and Chris will talk to you about shortly, mean that there is no longer any off-the-shelf recommendations for businesses. The right structure for your business will depend on a combination of factors that are specific to you. So what business are you in? Is it seasonal? Is it subject to averaging rules? When is your year end? How old are you? Sorry, I wasn't looking at you when I said that. When are you thinking of retiring? What does your pension pot look like? What are your income needs? Do you need to extract all of your profits every year? Do you have other sources of income? What's your family situation? Are you married? Do you want to provide income for your children? What income tax bracket are you in? Is your business growing? What does your capital expenditure forecast look like? And what is your appetite for risk? The answers to all of these questions will be different for everyone in this room. This is further complicated by the fact that when we have a change of government, which is likely to be sooner rather than later, I suspect, the tax rules will almost certainly change again. The Office of Tax Simplification has been abolished, but we still need to be mindful of their recommendations, which may well still be adopted by future governments. The OTS recommendations to bring capital gains tax rates in line with income tax and abolish uplifts in CGT base costs for IHT-friendly assets might be other reasons for business owners to consider restructuring now while CGT rates are low. So what this budget tells me is that now more than ever we need a strategic, holistic approach to tax planning that takes into account all of these things to provide bespoke solutions for each and every taxpayer. Given the number of issues that basis period reform has raised, I am personally hoping that it will be another 30 years before HMRC decide in their wisdom to change all the rules again. And by that time, I will hopefully be drinking cocktails in the sun, reaping the benefits of the pension changes that Graham's told us about. But what I do hope is that these onerous changes will act as a catalyst for the people in this room, for business owners, to review their operations, to enable them to improve cash flow, maximise profits, and pass on the hard-earned fruits of their labour to future generations. Thank you for listening, everybody. That's all from me. I will now hand you over to Chris.